Welcome to Mortgage University. If you've ever bought a home or you're thinking about buying one, you've heard the word mortgage 1,000 times. But most people don't actually understand what a mortgage is or how it really works behind the scenes. So let's break it down clean, simple, and real. At its core, a mortgage is just a loan used to buy real estate. You borrow money from a lender to purchase a home, and that home is used as collateral until the loan is paid off. That part sounds simple. What most people miss is how the money flows, how decisions are made, and what you're actually agreeing to. When you get a mortgage, you are not borrowing money from the bank's checking account. That loan is created, funded, and then usually sold into the secondary mortgage market to investors. Those investors buy pools of loans because they want predictable long-term returns. That matters because once your loan is sold, it has to follow very specific rules. Those rules affect your rate, your approval, your documentation, and what you can and cannot do during the process. Now let's talk about your payment. Your monthly mortgage payment is typically made up of 4 parts: principal, interest, taxes, and insurance. Principal is the portion that pays your loan balance down. Interest is what the lender charges for lending you the money. Taxes and insurance are usually collected monthly and held in escrow, then paid on your behalf when they come due. Early in the loan, most of your payment goes toward interest. Later in the loan, more of it goes toward principal. That's not a trick. That's amortization. Now, here's where people get tripped up. A mortgage is not approved based on how much money you have in the bank or how successful you feel. It's approved based on math, risk, and documented consistency. Lenders are asking one core question. Based on your income, credit, assets, and debts, how likely are you to make this payment on time every month for the next 30 years? That's why we look at things like debt to income ratios, credit history, job stability, and reserves. It's not personal. It's statistical risk management. Another big misunderstanding is rate shopping. Your interest rate is important, but it is not the most important part of a mortgage. Structure matters. Program selection matters. Timing matters. A slightly lower rate on the wrong loan can cost you far more long term. A mortgage should be viewed as a financial tool, not just a payment. The right structure can protect cash flow, preserve liquidity, and support long-term wealth building. The wrong structure can trap you. Here's the practical takeaway. A mortgage is a long-term financial agreement governed by rules most consumers never see. The better you understand how it actually works, the more control you have during the process. In this channel, we're going to walk through how lenders really think, how approvals really work, and what to watch for before mistakes happen. This is Mortgage University, and we're just getting started. I'm Ricky Camus, president of Epic Lending, and if you found this helpful and would like more information, reach out to me at 480-9999-9842 or shoot me a text.